Everything in life carries an inherent risk. From any situation, if you want to reap rewards, you may have to take chances or expose yourself to uncertainty. Similarly, when it comes to investing, risk and returns are two sides of the same coin, which is why stock or share prices rise in favorable conditions and you can make a lot of money, but when things don't go in the company's favor, you could lose money as well. If you're someone who wants to earn returns through investing in the equity market, you have to be prepared to undertake the risks involved as well. Understanding these risks will help you plan for safeguarding your investments against them. Let's begin with business risk. Equities and corporate bonds are prone to company-specific risks. In the case of sudden or unexpected management change, product failures, rising costs, and other risks to the running of a business, stock and corporate bond prices may fall. An obvious risk is that caused by inflation. In a high inflation environment, you will need to ensure that your investment returns are enough to keep pace with or beat inflation. Inflation can also adversely impact the performance of companies' stock prices as their profitability may decrease as a result. Liquidity risk is where you cannot buy or sell your investments easily as they have become illiquid, which means finding buyers or sellers is really tough. For example, you want to sell stocks of a company which doesn't seem to have any future earning potential, but no one is willing to buy these stocks. You will also face a similar problem with investments which have fixed lock-in periods. You can't sell them before they mature. Interest rate risk is the possibility of a change in interest rates, which in turn impacts the prices of debt and fixed income securities inversely. Let us understand the relationship between interest rates and prices better through an example. In 2013, Ram bought a debt security which offered him 8% interest rate at ₹100. Next year, the interest rates went up and the new debt securities issued offered 9% return and hence were more attractive to the investors. So, people were willing to pay only ₹95 to buy that debt security from Ram. Ram was upset and wished he had bought this security the next year. On the other hand, had the interest rates fallen to 7%, other investors would have been willing to offer a higher price to Ram to buy the debt security he held, because to them, it would appear more valuable compared to the newer debt securities issued at the lower interest rate. Now let us understand reinvestment risk. This risk refers to your inability to find a suitable investment option in order to earn similar returns that you earned from your previous investment. For example, in January 2014, Anup's debt security, which used to give him 8% annual return, matured. Work was hectic and Anup didn't have the time to reinvest this money, which was left unattended in his bank account. By the time Anup came around to figuring out what he wanted to do with this money, it was September and interest rates had now fallen to 7%. Anup couldn't find any security similar to his previous investment that would offer him the 8% return that he was getting earlier. This inability of Anup's to find an alternative investment option that gave him at least the same return as earlier refers to reinvestment risk. Credit risk is when a company or entity that issues debt is in danger of not being able to meet its commitment on interest payments or capital repayments. Increased credit risk impacts stock prices, the ability of a company to raise capital, and also affects bond prices. Geopolitical risk can be simply explained as the risk arising from the lack of political or social stability, which can affect the companies in such a region to a great extent. Currency risk is when unfavorable exchange rate fluctuations reduce the sales and profitability of a company if the company is involved in importing and exporting of goods. It could greatly affect the value of any foreign investments. Even if you invested in a foreign fund for which you paid in Indian rupees but whose securities were priced in a foreign currency, say the US dollar, exchange rate fluctuations will affect your returns. Market risk is when overwhelming events affect the markets and the value of investments. This risk is both unpredictable and extremely difficult to completely avoid, which is why it's also termed systemic risk, the risk always present in a system. Emotional risk is when your emotions and behavioral biases reflect on your investment decisions. For example, you're being extra conservative after you recently suffered a loss, or being over-aggressive with investments when the market has had a continuous bull run. Emotions should not cloud your judgment. Shortfall risk is simply the probability of you falling short of achieving your goal. What if instead of 5 years, it takes you 7 years to buy your dream house? Or what happens if your retirement corpus doesn't last your entire lifetime? What will you do then? Recognizing risks is important, but knowing how to deal with them is even more relevant. Let's look at a few simple steps you can take to deal with these risks better. You should become more aware. You can do this by simply understanding and reading up more on the risks involved when you invest. This can give you the comfort and knowledge required to deal with them effectively. It is important to identify your own risk profile and the inherent risk in a product. Knowing how much and how well you can handle risks will help you make wise investment decisions. Also, understand the inherent risk in the investment product. Match it to your risk profile and your goal orientation. You should understand the right risk-return balance for yourself. Now that you know your risk profile and the risk involved in the various products, set a balance between the returns you want and the right level of risk you can take while planning for your financial goals. It is very important to manage your investment portfolio. Diversify your investments by holding a balanced mix of asset classes and investment options within each asset class. Allocate assets such that it matches your goals, reduces risk, protects returns, and maintains liquidity requirements. Remember to stick to your financial plan and rebalance your portfolio when needed. It is beneficial to stay invested for the long term. Buying and holding investments for a long duration will not only give you the best chance to maximize returns but also help reduce risk. Markets fluctuate and you may lose money as they go down. But if you stay invested as and when the market recovers, you will gain. You may not have the time or the expertise to do all of this regularly, so it is highly recommended that you consider professional advice from an expert investment advisor from time to time to figure out how to manage and deal with any risks your investments may be exposed to. Lastly, fasten your seatbelts and prepare yourself for the ride ahead. Yes, it may be like a roller coaster, and if you're lucky, it could be quite smooth. Either way, embrace it, learn from it, and enjoy it. Before we end this video, here is a thought for you. The same risks that can make you feel worried are also opportunities that can enable you to earn great wealth. The same situations and the examples that we shared earlier could also have been positive and helped you gain tremendously. Remember how we started this video? Risk and returns are two sides of the same coin. Hopefully this information has helped you realize that you don't need to be scared of the risks related to investing as long as you're smart, cautious, and aware while planning your investment strategy and have learned how to manage your investments well. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.